You often hear this term thrown around in finance, smart money. It sounds a bit like something out of a movie, this secret club of investors who always win. But what is smart money, really? Is it just a myth, or is there a genuine group of players who operate on a different level?
It's definitely real, and understanding it is key to understanding how markets actually move. It's not about magic, it's about resources and information.
In the complex world of financial markets, the term smart money refers to capital managed by institutional investors, market makers, hedge funds, and other sophisticated financial professionals. These entities are believed to possess superior knowledge, advanced tools, and significant resources that allow them to influence market trends and make more informed trading decisions than the average retail investor.
Exactly, Mia. It's essentially the capital of the big players, the institutions, the funds who have the resources and expertise to move markets, as opposed to individual traders who might be driven by emotion or uh, less comprehensive analysis.
So, it's clear that smart money is all about informed, well resourced capital. But what exactly gives these players their edge? What are the specific advantages they hold over the rest of us?
Well, that's where it gets really interesting. It's a combination of technology, scale, and strategy.
The advantage of smart money lies in several key factors. Firstly, these institutional players have access to superior research, real time data, and advanced technological tools that individual traders often lack. Secondly, their sheer volume of capital allows them to execute large trades that can move markets, create liquidity, and even influence price action in ways that smaller investors cannot. They also employ sophisticated strategies like utilizing dark pools and block trades to execute large orders without causing immediate price spikes.
That access to cutting edge data and tech, combined with the sheer muscle of their capital, creates a feedback loop. They see what's happening, they can act on it at scale, and their actions then create the very movements that others then try to follow.
David, you mentioned dark pools and block trades. What's the real significance of using these less transparent methods? It sounds like they're actively trying to avoid the public market.
Precisely, Mia. The so what is that they're not just trading, they're actively managing information flow. By using dark pools, they can execute massive orders without tipping their hand to retail traders or even other institutions until after the trade is done. This prevents their large buy or sell orders from immediately driving the price against them. It's about executing their strategy with minimal market impact before the broader market can react.
I see. So it's not just about having more money, but about having smarter ways to deploy it, often behind the scenes. That brings us to the next crucial question. How can a retail trader actually identify these smart money movements in the first place?
It's tough, but there are definitely footprints they leave behind if you know where to look.
Identifying smart money activity involves looking for specific clues and patterns in market behavior. One common indicator is a sudden spike in trading volume, especially when it occurs without any significant news or public information that would explain such activity. Price action analysis is another crucial method, with concepts like break of structure and change of character used to identify shifts in market structure driven by smart money. Additionally, traders look for order blocks and liquidity grabs, which are areas where large institutions place significant buy or sell orders.
It's like being a detective. You're not just looking at the headline news, you're looking for the unusual surges in activity, the subtle shifts in market structure, and the deliberate traps being set for less informed participants. You see a liquidity grab, for instance, where they push the price down just enough to trigger a wave of retail stop losses, buy up those shares on the cheap, and then drive the price in their intended direction.
Fascinating. So, we've defined smart money, understood its advantages, and now know how to look for its tracks. But what's the ultimate impact of all this? And what should a retail trader take away from it all?
The impact is huge. They're the ones drawing the map in many ways.
The influence of smart money is undeniable. These large players can shape market trends, create liquidity, and drive price movements, often setting the stage for subsequent market activity. For retail traders, understanding and attempting to follow the movements of smart money can be a strategy to align with institutional capital and potentially improve trading outcomes.
Exactly. It's about leveraging their insights and actions to inform your own decisions, but never forgetting that they are still fallible and your own risk management is your ultimate safety net. Blindly copying is a recipe for disaster.
A crucial distinction. So, while we can't all be institutional investors, by understanding these dynamics, retail traders can certainly navigate markets more intelligently. To wrap things up, David, could you summarize the absolute key takeaways for our listeners?
Of course. First, remember that smart money isn't a single person. It's the capital from big, sophisticated players like hedge funds, a stark contrast to retail investors. Second, their edge comes from better data, more advanced tools, and just a massive amount of capital to deploy. Third, you can spot them by watching for weird spikes in volume when there's no news, and by learning price action concepts like break of structure or looking for those liquidity grabs we talked about. And finally, while following them can be a useful strategy, it is never a substitute for your own solid risk management. They aren't always right.